Fox Business.
The relaxing of the mark-to-market accounting rule that came about yesterday may provide the boost battered banks really need to start lending again.
But by allowing banks to adjust the value of their assets to what they might be worth, are we getting in the same trouble that got us here in the first place? Illinois Republican Congressman Mark Kirk doesn't think so. He joins us now from Washington with his thoughts on the rule change. Good to see you, Congressman. Thanks for being here. Now, as you may or may not know, I work with Mr. Steve Forbes on another program who's been a huge supporter of this. Steve thought that we're going to see about a 1,000-point boost once we got rid of mark-to-market, and the market kind of presaged what happened yesterday, and it did go up quite a bit, but was it all that you wanted it to be, the changes that were announced?
No, we have two big changes that we're working towards, reimposing the uptick rule and mark-to-market reforms. Mark-to-market required every bank in the country to value their assets, mainly mortgages, as if they were sold at a fire sale tomorrow. We know that 90% of mortgages are performing on time, fully paid, and on schedule. To mark those assets at far below prices or near zero, I think inaccurately stated the accounting situation that many banks faced. The reforms that we put in place are a tremendous boon to banks. And we didn't get away with mark-to-market. We simply said the assets should be valued according to an orderly sale, not a fire sale tomorrow morning.
An orderly sale, so that's the key word there. But, Representative, you say in one of your op-ed pieces, most American mortgages have intrinsic value that a fire sale value does not reflect. Meaning, come on, I mean, obviously, if you knew in normal economic times you were to sell this thing, it would be valued at way higher. Here's my issue with this, because we've had a lot of smart people like Bob Olstein of the Olstein Fund say keep mark-to-market because it's a fair situation when you're looking at a free market. Yes, we've got a very difficult time that we're facing right now, but nobody's fixing the mark-to-market on my own portfolio. I do have to stick with the fire sale price if I had to liquidate tomorrow.
Well, your portfolio will be dramatically improved because of this change. It's one thing to say that banks should value their assets according to mark-to-market file sale prices tomorrow morning, but that, I think, inaccurately states the value of fully performing mortgages where families are completely up to date on their payments. That's why the orderly sale wording, I think, leads to a much more rational result, and one, quite frankly, that will be more accurate in the long-term assessment of bank values.
But were your expectations a little too high about the effect that this change would have in the markets? Bank stocks, for example, a lot of people said, well, Citi and other banks like that are going to get a 20% pop as a result of this. I'm looking at Citi right now, still trading at $2.75 a share.
There's two things I think that happened. One, obviously the market anticipated this. It was widely expected over the last 2 weeks. And so the market priced in this gain, but it has helped building a floor underneath this market. Secondly, this is a tremendous boon, not just for Citibank, but for community banks across America who will really begin to start lending now that their balance sheets will improve using orderly sale mark-to-market accounting and not fire sale prices.
Let's talk about the TALF. Do you think that this, at least what we've seen so far with scaling back mark-to-market, would that then help sort of scale down the TALF, which is that window, that discount window that banks can walk up to now with the Federal Reserve and borrow money?
I think it will. It will make their balance sheets look better. Along with reform of the uptick rule, I think we're going to remove the engines that have led to what Alan Greenspan might have called irrational pessimism on the market. I think these reforms force us to look deeper at intrinsic values of assets. And I fully believe in completely discounting mortgages which are not being paid in neighborhoods where foreclosures reach a critical mass. But for fully performing mortgages that are completely on time, there should be quite a value in those mortgages and securities behind them.
But, Congressman, as long as there is a possibility out there that the government is going to come in either through the Fed or the Treasury and buy up some of these assets at inflated prices, aren't the holders of MBSs and everything still going to hold on to these assets until they can get the highest price they can?
You're exactly correct, and that's where Secretary Geithner's lack of specificity, I think, has hurt the market. When you're dealing with a panicked market, you're going to be setting an arbitrary price, and you do realize that no matter what price you set for those purchases, you'll be blasted for paying too much or paying too little. That's why I have really focused less on the government's intervention and more on a couple of these big changes which have investors look at the actual performance of many of these mortgages. With over 90% performing on time, they are simply worth more than what the panic market has been pricing.
Mark Kirk, Republican from Illinois. It's great to see you, sir. Thanks for coming.
Thank
Please
you.
come back and see us again.
Thank you.
You bet.
Well, we're down more